Hello, welcome to this presentation on how the United States taxes what are called controlled foreign corporations. I'm Jacob Stein, I'm a partner in Aliant's Los Angeles office, and international taxation is one of my major practice areas. A controlled foreign corporation is a tax classification of a foreign entity. And most every major country in their tax code and their tax rules will have this concept of a controlled foreign corporation. So in this short video, we will talk about how the United States classifies foreign corporations as controlled foreign corporations. Well, what does that mean to our clients and how do we plan around these rules, what the tax consequences are. So what is a controlled foreign corporation? The definition is fairly straightforward. Under US tax rules, if an American establishes a foreign corporation and that foreign corporation is primarily owned by American shareholders, it's a controlled foreign corporation. So here are the technical definitions. It's a foreign corporation, more than 50% of it is owned by those US shareholders who each have 10% or greater interest in the corporation. So foreign corporation, we are looking for those shareholders in the United States who each have a 10% or greater stake in this corporation. And then we look whether in the aggregate, these 10% or greater shareholders add up to more than 50% of the ownership of the foreign corporation. And this is ownership both by vote and value, meaning that if Americans control more than 50% just by vote, we have a controlled foreign corporation. If they own more than 50% by value without the vote, it's a controlled foreign corporation. So first we're looking at a foreign corporation that's fairly simple, right? It's a foreign entity that's under the laws of the foreign country is classified as a corporation. And the United States in its tax code in section 7701 will have a list of all kinds of foreign entities, like hundreds of them, and which ones are corporations, which ones are not corporations. And primarily it deals with whether every owner of this foreign entity, do they have liability limitation? Meaning if there is a lawsuit against this entity, can that lawsuit proceed against the individual owners? If the answer is no, we likely have a corporation or an entity that the United States will classify as a foreign corporation. So then we look at what percentage interest does each shareholder have. So let's say we have a foreign entity, and this foreign entity is equally owned by 25 people in the United States. Is that a controlled foreign corporation? And the answer is no. It is not a controlled foreign corporation because none of these shareholders have a 10% or greater interest, right? They each have a 4% interest. So if that is the case, the foreign corporation is not a CFC. What happens if it's not a CFC? Well, that's a really good result because now this foreign corporation can make money overseas, can make money outside of the United States, and our clients here in the United States, the US shareholders, are not taxed on those profits until the money is actually brought back into the United States. So there's an opportunity for a deferral, right? We do not tax this income of the foreign corporation until the money comes back to the United States. And that's a great, great, great result. But if we do have these 10% shareholders, right? So each person has 10% or greater interest, and together they all add up to greater than 50%, we have a controlled foreign corporation. So the most classic example of a controlled foreign corporation is a foreign corporation that is entirely owned by a US person. That's a controlled foreign corporation. Once we have determined that a foreign corporation will, for US tax purposes, be classified as a controlled foreign corporation, what does that mean? It means that our US shareholders, those who have 10% or more in this corporation, will be currently taxed on certain types of income that this corporation generates, even if they do not get any cash distributed to them. Right? So it's almost like it's a flow-through system of taxation. The corporation earns income, and you as shareholders are taxed on that income as if it was distributed to them, as if they received that income. What kind of income? Well, there are several categories of income. The most important one is passive income. Anytime a controlled foreign corporation generates passive income, income like interest, dividends, rents, royalties, US shareholders are currently taxed on their share of that income, as if they earned it, okay? Even though no cash was distributed to them. The other category of income is what's known as foreign-based company sales income, and the third category is foreign-based company services income. These are the primary categories that U.S. shareholders will be taxed on. Foreign-based company sales income is when the foreign corporation is engaging in sales, and these sales take place outside of the country where the foreign corporation is organized. And somehow the U.S., there is a U.S. connection in the chain of sale. And I'll give you an example in a second how that works. And the third category, foreign-based company services income, this is when the foreign corporation is providing services, again, outside of the country that it's organized in. And there is a relation to someone in the United States in the chain of service provision. So I'll give you an example of foreign-based company sales income. One of the best-known examples is Apple. Apple has a subsidiary corporation in Ireland that Apple set up back in the 1980s. And through this Irish subsidiary, Apple sells all the iPads and iPhones and whatever it is that Apple sells outside of the United States, right? Everything goes out through this Irish subsidiary. So the Irish subsidiary is a controlled foreign corporation because it is 100% owned by an American taxpayer. Apple Inc., right, owns 100% of the Irish subsidiary. So now we look at what sort of income is this Irish subsidiary generating. Well, it's generating sales income, and it's generating sales income primarily outside of Ireland, outside of the country that the subsidiary is organized in. So is Apple currently taxed on the earnings of the Irish subsidiary? The answer is surprisingly no. Why not? Because there is no relationship in the chain of sale to a party in the United States. If the Irish subsidiary was buying the iPhones from Apple in the United States and then selling those iPhones to Germany, Apple would currently be taxed on the income generated by the Irish sub. But the Irish sub does not buy the iPhones from Apple in the United States. The Irish sub owns 1/2 of all of Apple's intellectual property. And because of that, it is able to buy the iPhones and the iPads and all the other products directly from the manufacturer in China, which is an independent third party. So the Irish subsidiary buys the iPhones from the manufacturer in China and sells them to the customers in Germany, let's say. There is no related party in the United States involved in that chain of sale, which means that this Irish subsidiary, even though it's a CFC, is not generating foreign-based company sales income, which means that Apple in the United States is not taxed on that income. Apple, by some accounts, now has over $120 billion of cash in the bank account of its Irish subsidiary. The money has never been taxed by the United States. And this is a structure that's used by Google and Microsoft, by every Fortune 500 company, and it's a structure we set up for a lot of our clients. If properly structured, all the earnings outside of the United States can be deferred for tax purposes. I'm Jacob Stein. Thank you for listening to this presentation.